Hey everyone, welcome. We're going to dive into something pretty wild in the financial world today. It's all about how a company's stock portfolio can totally swing its profits, even if they never sell a single share. So, yeah, let's get right into it.
So just think about this for a second. You've got giants like Apple or, Berkshire Hathaway, and they're investing billions of dollars in the stock market. How do those bets they're making, how do those wins and losses actually hit their profits? Is it only a thing when they finally decide to sell? What's the deal?
Well, this is the kicker. It's not just when they sell. Believe it or not, those paper gains and losses, the value of their stocks just going up or down on a screen, can directly impact the income they report to everyone each quarter. It's a huge deal.
Okay, so to really get this, we're going to break it down step by step. First, we'll cover some basic terms. Then we'll look at the accounting rules, which are all about how much influence a company has. After that, we'll walk through a real example to see how this fair value thing works, touch on an important exception called impairment, and then wrap up with why all of this is so important.
All right, first things first. Before we can get into the really cool stuff, we have to learn to speak a little bit of accountant-ese. So let's start with the absolute fundamentals to make sure we're all on the same page.
So the first big term you need to know is equity security. I know it sounds super formal, maybe a little intimidating, but it's really not. It's just the official way of saying you own a piece of another company. It's basically the same thing as the common or preferred stock you'd buy in your own brokerage account.
Okay, now here's where things get really interesting. The way accountants handle these investments all comes down to one single idea: control. Or more specifically, how much influence the company doing the investing has over the company it's putting money into. This picture here lays it all out pretty clearly. Accountants kind of use the percentage of ownership as a rule of thumb. So if you own more than half the company, over 50%, that's control, and the accounting gets, really complicated. If you're between 20 and 50%, that's called significant influence. But the one we care about today, the most common situation by far, is when a company owns less than 20%. That's considered little or no influence.
Yep, and that little bottom section is exactly where we're going to be focusing. When a company falls into that little or no influence category, there's a specific accounting method they have to use. It's called fair value measurement.
Okay, so we've got the name of the rule, fair value, but what does that actually mean? Let's dig into how this works, because this is really the core of what we're talking about today. This table breaks it down beautifully. You see, on the balance sheet, the investment's value is always being updated to whatever its current market price is. But, and this is the really important part, look at that income statement column, that unrealized holding gain or loss. That's our paper gain or loss we've been talking about. It gets reported right on the income statement. It directly affects the company's profits. And the official guidance is crystal clear on this. It says those unrealized gains and losses from remeasuring the investment are reported in the income statement. So what does that mean in plain English? It means the everyday chaos of the stock market can make a company's reported earnings jump all over the place. Okay, that's enough theory for now. Let's make this real. We're going to follow a made-up investment from start to finish and see exactly how all these rules actually work in the wild.
So here's the setup. Let's say on November 1st, there's a company called Abico. They've got some extra cash and they decide to invest it. They go out and buy 200 shares of another company, Galeco, for $100 a share.
The math on that is super simple, right? 200 shares times $100 per share gives you an initial investment of $20,000. And that's the number that goes on their books, on the balance sheet, as the starting point.
But of course, we all know the stock market never just sits still. So fast forward to the end of the year, December 31st, and oops, Galeco's stock has dropped. It's now only worth $90 a share. Now, keep in mind Abico hasn't sold a single share. They're still holding on. But because the price dropped by $10 a share, they have to report a paper loss of $2,000. And where does that loss show up? You guessed it, right on the income statement, which means their reported profit for year one just went down. But the story isn't over. Let's jump ahead another year. It's now the end of year two. And what do you know? Galeco has made an amazing comeback. The stock price has shot all the way up to $115 per share. So, what's the move now? Well, to figure out the gain for year two, you have to compare the new price to what it was at the end of last year. So it went from $90 up to $115. That's a $25 jump per share. You multiply that by the 200 shares they own, and boom, Abico gets to report a $5,000 unrealized gain in its net income. Their profit for year 2 just got a nice boost, and they still haven't sold a thing.
Now, there is some fine print here, an important little rule. Accountants can't just blindly hope that a stock that is tanked is going to bounce back. They actually have to check if that drop in value might be permanent. And this leads us to a concept called impairment.
So, what is impairment? Think of it like a formal reality check. It's a way to see if a stock's fall from grace is more than just a temporary blip. So at the end of every reporting period, accountants have to look for red flags, Things like, is the company they invested in about to go bankrupt? And if the value on their books is way higher than the current market price, and it doesn't look like it's coming back, they have to officially record a permanent impairment loss. And yeah, that hits the income statement too.
Okay, we've covered a lot of ground, so let's zoom out and boil it all down. What's the one big idea you should walk away with today? It's this. A company's stock market wins and losses flow directly to its bottom line, its profits, even before they sell a single share. The daily roller coaster of the stock market literally gets baked into their official financial results every single quarter.
So I'll just leave you with this thought. The next time you see a company's earnings report pop up in the news, will you maybe look at it a little differently? Will you wonder just how much of that profit they're bragging about actually came from selling their products, and how much of it just came from their stocks having a good couple of months?